All right. Today is Wednesday, March 22nd. This is a recap for the stock market activities today. Now, folks, I got a good one for you tonight, and let's begin with this. We have a major dilemma in the economy right now. We knew that at some point we're going to head here. What are you talking about, Maverick? I'm talking about the fact that the Fed was way behind the curve. And it continues to be, by the way. And in this channel, since the first quarter of 2021, we've been warning the Fed that you gotta start tapering now, Mr. Powell. Inflation is not going to be transitory. The tightening of the monetary policy must begin now. Of course, the Fed dismissed inflation as transitory, not just the Fed, but also the White House, the Treasury Secretary, the economists, the experts, the talking heads on TV. Everybody was saying that inflation is transitory. No need for reaction by the Fed. Of course, at some point, when the evidence became too much, the Fed finally admitted that inflation is not transitory and they have to start tightening the monetary policy. But in correcting the mistake, they made another one, which is they were too shy with interest rate hikes. They were afraid that if they do too much catching up, God forbid the stock market might go down. So they caught up to the problem too late, and their approach was, yes, we're too late, but we're going to tackle the problem gently. Little by little by little. Instead of sprinting faster, looking at the distance between the Fed and inflation and saying, oh my God, we got a lot of catching up to do, we have to go guns blazing. Had the Fed sprinted faster, went guns blazing, inflation would have been at least more under control right now. It would have been in the 4/5 territory, which is more manageable than the current 6+ inflation rate. Because you see, the problem with fighting inflation is the longer you wait, the more damage it does to the underlying economy. And by the time the Fed realizes that this is what's going on, what they've been doing so far is not enough and they have to do more, they're going to look around the economy and see a much weaker economy than, let's say, 6 months ago, a year ago. And if they decide to become more aggressive now versus in the past, understand that the economy is a lot weaker. So the damage will be more measurable as the Fed raises rates while the economy continues to weaken. On the other hand, if the Fed says, okay, we made a mistake of dismissing inflation, then we made the other mistake of catching up with inflation a little too gently. So we have to be more aggressive. The problem is the economy is too weak right now to handle the aggressiveness. So what do we do? What do we do? Well, you get two choices. Either you let inflation go, we lost, inflation is going to continue to go higher and wreck the economy, or we hold our noses and realize that whatever aggression we do right now to tackle inflation down, whatever damage that will produce now is a lot better than 3 months down the line, than 6 months down the line, than a year down the line, because the economy will be a lot weaker then than now. But the problem is, in choice number 2 is, a lot of things in the economy will blow up in this fight against inflation. And this is the major dilemma, the unfortunate position that we and the Fed find ourselves in right now. We know that earlier in the year, the Fed made the mistake of saying, okay, we're seeing inflation moving down a little bit, so we're going to ease from 50 basis points to 25. The problem with that is, now the gap between the Fed and inflation is opening up again. And inflation stood back on its feet and said, hey, Fed, look, I'm moving away from you. We saw the CPI, the PPI, the PC inflation rate, all the indicators saying that inflation is moving higher. And as the Fed said, okay, we made another mistake yet again, and we have to catch up now more aggressively, the economy responded by saying, here's the problem though. If you do that, Fed, Silicon Valley Bank will blow up, First Republic Bank will blow up, Signature Bank will blow up, a lot of other lenders will blow up, commercial real estate will blow up, residential real estate will blow up, a lot of the auto lenders will blow up, a lot of companies will blow up because the economy is a lot weaker right now than it was a few months ago. It can no longer handle more rate hikes. There's a lot of debt in the system right now. And of course, we're seeing things such as mortgage demand all of a sudden increasing. Yet another indicator that inflation is about to move higher again. Existing home sales smashed records we haven't seen since 2020. Take a look.
Existing home sales in February jumped a whopping 14.5% month to month to a seasonally adjusted annualized rate of 4.58 million units. That is the first monthly increase in a year and the largest jump since July of 2020, according to the realtors. Of course, that's when the pandemic started, also well above the 5% gain the street was predicting.
And folks, it's not just happening here. Today in the morning, we got another bomb from the UK. Inflation rebounded higher in the United Kingdom in a U-turn, rising to 10.4%. And this is typical behavior of any inflation phenomenon. You have to continue to fight it. You have to continue to choke inflation. The moment you let your hands go, it's going to rebound higher again. And of course, as we explained, central banks, not just the Fed, they find themselves in an unfortunate dilemma. And now they have to speak with both sides of the mouth. Hey, public, we haven't given up on the fight against inflation yet. Believe us. But we are aware of what's going on around us with banks blowing up, and we can walk and chew gum too. This is what Lagarde said. This is what Powell said today. And the disaster in today's approach by the Fed is the following. You see, Jerome Powell knows that he's not going to be able to catch up with inflation. The distance is too far now. And if he continues to raise rates higher and higher and higher, things will blow up. He will catch up to inflation if he become aggressive, but he will destroy the economy. So his newest trick right now is, okay, maybe it's too late for me right now to become too aggressive, but what if all of these bank blow-ups and the systemic risk that we're seeing right now, what if that's going to take care of inflation? What if the collapse of the economy will take care of inflation, which is absolute delusional thinking. He even went as far as, oh, maybe we're going to have the soft landing after all. Maybe if I raise by a little bit so I can save face, and then let the banks blowing up and the tightening of credit conditions, aka the recession in the economy, maybe that's going to take care of inflation for me, and then we're going to have a soft landing and live happily ever after. The man today was absolutely confused. He had a deer in the headlight look, and it wasn't just Powell alone. It was Powell and Janet Yellen, a duo, a disastrous duo of senile leaders who have absolutely no clue what they're talking about. And you wonder why the stock market went down big today. Matter of fact, the Dow Industrial Average closed down by more than 400 points today alone. And folks, we've been talking about the delusional stock market rallying and dismissing everything. Yet all indicators are pointing out that, hey, this is big. This is a recession in the making. And I shared with you last night on Discord this, the Morningstar LCTA US Leveraged Loan Index. Every time it bottomed, we saw a bear market rally in the stock market. So there is a degree of correlation between the index and between pricing in the stock market. And as of late, this index was actually moving down while the equities market was moving higher. So that was one among many warning signals. But folks, we have to take it one step at a time, because in last night's video, I thought we will see the revival of the recession theme, at least momentarily. Maybe bond yields will rally for a little bit. Maybe the dollar will catch a bid. But the market's reaction today was shocking even to me. The market did not even entertain a resumption of the inflation theme. The market reverted right back into the recession theme deep, with gold rallying, with bond prices rallying, with equities, the dollar, and bond yields crashing together. And last year, I told you guys, when that happens, you'll know that we're in a recession now. Once again, we'll take it one step at a time. Maybe today's action was a knee-jerk reaction. Maybe tomorrow things will be a little better, maybe. But if tomorrow we continue to see the recession theme playing out, oh boy, buckle up, we got a lot of problems to come. With that background out of the way, let's cover what happened today in the FOMC and the conference by Jerome Powell by revisiting the wall of worry and the Federal Reserve.
Our banking system is sound and resilient with strong capital and liquidity.
But all joking aside, heading into the FOMC, the bull's assumption in a nutshell was the economy is getting bad, so the Fed will have to ease, and this is good for stocks. This is 2018 once again, the Fed's pivot. This is not 2008 in the financial crisis. This is what the bulls were assuming. The bears, on the other hand, the assumption heading into the meeting was, perhaps still is, yes, the economy is getting bad, but inflation is still too high. The Fed will not ease until something bigger breaks. And by that time, we will be in a recession, so Fed easing will not be helpful at the time. Guess what happened in today's FOMC, specifically in the conference? Forget about the statement. It was a confirmation of the bears' theory. A, the Fed is not easing, and they're only going to ease when things get really bad. And a lot of folks forget that back in 2008, it was not the Fed's easing or pivoting from interest rate hikes that saved the economy in the stock market. It was billions and billions of dollars of bailouts, of direct injection into banks and companies. But we have a lot of misunderstanding these days. You might have seen in social media and Twitter, for example, that, oh, the Fed is back and doing QE. This is good for stocks. But is it really QE? Is it really a stimulative policy? Or is it a rescue plan for banks? More on that in a minute. But the bulls got one thing they can hang their hats on, and that is Jerome Powell opening up the possibility that he might not need to do more rate hikes because the implosion of banks and the tightening of credit conditions might be the equivalent of interest rate hikes. Take a look.
So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate.
And of course, the bulls loved this statement that maybe it is hinting at the end of interest rate hikes. Now, I'm trying to be as open-minded as I can, but the Fed just raised rates by 25 basis points. And he says that the tightening of credit conditions by banks is the equivalent of interest rate hikes. Maybe 25, maybe more than 25. So isn't it the case that effectively today the Fed raised rates by more than 50 basis points? It was beside me why the bulls took this as a good sign. But hey, maybe I'm misunderstanding things here. I'll give them this point. The bears, on the other hand, got plenty more validation. Number one, leaving the door open for more interest rate hikes. Now, JP did not say that explicitly, but he said maybe more firming. Again, more word salad, dancing around the reality, thinking that we're a bunch of fools, that if they change the wording a little bit, maybe we're not going to be as concerned as we were before. Hey, Fed and Jerome Powell, we know what you guys are doing, and it's not giving us any comfort. If anything, all of this weaseling around is freaking out market participants and freaking out the economy. Be straightforward and say it like it is. Do you think where the economy stands right now, do you think that more interest rate hikes are merited or not? Simple as that. But no, they have to say, oh, we see more firming happening. What the hell does that even mean? But anyhow, perhaps most importantly, the bears won in the argument of, oh, is this QE or not QE? We know that the Fed's balance sheet increased by about $300 billion. And the bulls were saying, look, you guys been saying, the bears meaning, you guys been saying don't fight the Fed. Okay, the Fed is now easing. Are we fighting the Fed, the bull side, or is it the bears now fighting the Fed as we see the Fed resuming QE? Well, here's Jerome Powell settling the argument. Take a look.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways, so let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy.
So he slammed the door shut against, oh, this is the resumption of QE. If anything, he cannot afford to resume QE while inflation continues to rebound higher. So the bears won in this argument. And perhaps the most important one of them all, the market has been rallying under the assumption that not only the Fed will pause in this meeting, but perhaps also announce interest rate cuts. Maybe the Fed will be kinder and gentler. Well, here it is.
Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So. Thank you very much.
So Jerome Powell was firm that there are no rate cuts coming. We know that give it a few days, a few weeks, something bigger is going to blow up and then it will be forced to cut rates. And when that happens, the conversation becomes what happens to inflation? Will inflation go down because something blew up in the economy and took down inflation with it? Or is the distance between the economy right now and inflation too far that whatever blows up right now is not going to take inflation down? That is another conversation that we will talk about down the road, not right now. But maybe you've seen this. I think the market today understood for sure that Jerome Powell is an incompetent fool. You might have seen this floating on social media today. The question was really simple. His answer was absolutely absurd. Take a look.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Dude, you're the Fed chairman. You don't know what's going on? You don't know what happened in Silicon Valley Bank? The San Francisco Fed doesn't know what was happening? All the fraud, all of the risk taking, no oversight at all? You don't know what's going on? Are we supposed to have confidence in banks or in the Fed when you have absolutely no clue what you're doing right now? And it gets worse, folks, because it was a double whammy today. Not just the incompetency of Jerome Powell, but of course, perhaps more importantly, the incompetency of Janet Yellen. Take a look.
Some of our colleagues, including Senator Elizabeth Warren, has recommended that we raise it to $2 million or even up to $10 million. Do you agree with that?
You know, what I'm focused on right now is trying to stabilize the banking system, and I know our banking system to be sound, and I think right now we need to focus on improving the confidence of the public that we do have a sound banking system, and we can debate in the days ahead whether or not $250,000 is the right level for deposit insurance, or whether that system should be changed in some way. I'm not going to weigh in on it. I believe there's plenty of time to have reasoned discussions about that.
You're not going to talk about it right now, Janet Yellen? You're going to have a lot of time for discussion? Things are blowing up right now, ma'am, and you need more time for discussion? She keeps saying, the banking system is safe and sound, and the American public is How can we have any faith on the health of the banking system if you guys are not going to insure our deposits? Because God forbid the banks might have to pay more. Or maybe our bankrupt government, Mrs. Yellen, that is about to face a debt ceiling, by the way, and a debt crisis, cannot really afford to insure all of these deposits. And the problem is, she doesn't know what she's talking about. She has no clue how the rules even work. Take a look.
So, Madam Secretary, does insuring every deposit at every FDIC-insured bank in the nation over $250,000 require congressional approval?
This is not something that we have looked at. It's not something that we're considering.
Okay, so it's not something you looked at. It's not something you're considering. But all day she's been saying, the banking system is great and it is strong and sound, and Americans should have faith on their banks. Your deposits are safe. And then with the same breath, you say, deposits are not going to be insured. It's not something we're considering, even. Oh boy. You thought that the bank runs that we've seen so far were bad? When Janet Yellen says, clearly, we're not going to insure your money. Take your money out of these banks. Okay, we're going to take our money out of these banks, and they're going to crash and create a massive systemic crisis in this already fragile economy. What a bunch of fools, folks. What a bunch of senile, incompetent leaders. All what we need right now is sound leadership, Mr. Powell and Mrs. Yellen. Somebody strong, somebody confident, somebody who knows what they're doing. They assure the American public not by words and gaslighting, but by actual data and a plan. Not, oh, we're going to discuss it later on. A plan ready to be deployed right now. Folks, this is a disaster. And I don't know if the stock market can continue to ignore this. For your information, what we're seeing in banks right now is happening across corporate America. All of them been buying assets, and these assets right now are losing an insane amount of money. Most of our companies right now have an insane amount of debt. This problem that we're seeing right now is just beginning. I don't mean to be an alarmist. I don't mean to be a spreader of fear. I wish I could come to you right now and say that everything is fine, everything is under control. Trust the banks, trust the Fed, trust the Treasury Department, trust the White House. But can I say that in good faith? Absolutely not. And the market reaction today was, we're gonna go into a recession. We'll see whether that's gonna stick or not. And to figure that out, why don't we go ahead and cover the stock market information for you? We begin with the closing of the indices today, and here we go. The Dow Industrial Average down by 530.49 points, or a decline of 1.63%. The Nasdaq down by 190.15 points, or a decline of 1.6%. The S&P also down by 65.90 points, or a decline of 1.65%. When it comes to the sectors, all in the red, but look at the massacre that we got today in real estate. Rates moving higher, lots of sectors in real estate will blow up. Starting with commercial real estate, then residential, and the dominoes will continue to fall. Defensives faring a little better coming at top, but can they really weather the storm? That remains to be seen. The assumption is they should be. But today, they also went down big. When it comes to the breadth, absolutely awful. The NYSE, 12% advancing versus 87% declining. The Nasdaq, 22% advancing versus 76% declining. When it comes to commodities, the dollar was down, yet energy were weak across the board. This is the action in the after-hours session. We're seeing some rebounds in natural gas, some rebounds in crude, but it remains to be seen whether the action that we saw today in commodities is algorithmic in nature or not, because the dollar went down along with equities, which is usually a sign for a recession. Now, we know when the dollar goes down, sure, commodities will appreciate in value. Yet another confirmation for a recession is when the following happens. The dollar goes down, but commodities also go down, with exception of precious metals, gold and silver. Today, it's kind of hard to say. We know that gold and silver were up for the day, up by about 1% apiece. Copper was down by a little bit, grains were down, softs were soft, and the same goes for meats. But perhaps the most accurate indicator is energy. If the dollar continues to go down tomorrow, we see energy diving down, but gold and silver holding, boy, that's yet another sign that we have a recession coming. And it's not going to come 2 months from now. It's around the corner. On to the big casino, the options market. What do we see here? The volume all in all is up for the most tradable names. And as you can see, calls outweighing puts by a lot. So the assumption today was higher we go. And it looked like it for a little while. And then came the moment of reality. So we're going to see if the traders are going to buy more puts tomorrow or not. But for now, the hottest table by far was Tesla, the souffle, with around 2 million contracts traded today. About 59.5% of those were calls. And at number 2, bucking the trend, it continues to be the stickiest name so far, actually closing in the green, believe it or not, Nvidia, with around 1.4 million contracts traded today. Once again, we see puts outweighing calls. 52.5% of the spread was actually puts, not calls. At some point, the bears are going to get it, but they need that little bit of help. They need the mechanics to start to play out, and the mechanics are not going to play out until Nvidia goes all the way down to 250. That's step number 1, and then 230, but it got to close definitively below 230. Not just a touch, definitively. And then this name will go down big. AI, all that stupidity will not save Nvidia. And at number 3, Apple, with around 1.1 million contracts traded today, about 54% of those were calls. On to the unusual activities that took place in the options market today. We begin with the ticker double D for DuPont. The name was down today, just like the rest of them, but somebody sees it bouncing higher, and they bought the $80 calls for the expiration date May 19th, with expectations that the name will move higher and gain more than 17% by then. They paid around 40 cents a piece to enter this trade, all in all spending around $1 million. And then what about the ticker ABR? This is for Arbor Realty. Stay stay away from these rates. They're gonna blow up. That's the next one. And somebody sees it coming and they bought the $10 puts for the expiration date May 19th, with expectations that the name will move down and lose more than 10% of its value by then. They paid around 75 cents a piece tenor. This trade, all in all, spending around $1 million. And then we have the ticker KMX for CarMax. That's yet another bomb that's about to blow up. Not CarMax specifically, but the auto loan disaster. In any case, somebody sees CarMax going down and they bought the 52.5 puts for the expiration date May 19th, with expectations that the name will move down and lose more than 8.5% of its value by then. They paid around $3.5 a piece tenor. This trade, all in all, spending around $3.5 million. Last but not least, at the bottom of the table, what about the ticker EQT? I have a love-hate relationship with EQT. I own the name, but my relationship with it is the same as Jim Cramer's relationship with NVIDIA. Someday I love it, others I hate it. But if you happen to be bullish, you gotta stick with EQT. And somebody sees the name moving higher. They bought the 35 calls for the expiration date May 19th, with expectations that EQT could move higher and gain more than 19% by then. They paid around 75 cents a piece tenor. This trade, all in all, spending around $1.5 million. On to the heat map. What do we see here? Bloodbath across the board. Not even healthcare could withstand the storm, not even the defensives, nothing. The exception being gold, and of course the clown show in NVIDIA and AMD. And grab your tinfoil hat for me. What if what we're seeing right now in NVIDIA and AMD is a Bill Wang kind of phenomenon? Somebody taking a lot of leverage to buy a lot of calls and pump NVIDIA higher, then they get caught, NVIDIA, AMD, they go down big, and then we find out about the other disaster. Which bank is lending to this gambling? Just the tinfoil hat theory for now. But we also have, if you look at consumer defensives, my largest holding is in KR Kroger. That's holding up pretty good today. But this doesn't give any assurances, folks, that we're out of the woods. The market, once again, is reacting based on recessionary fears. Of course, some names will catch a bit tomorrow. Some of the action that you're seeing right now is a knee-jerk reaction. We're going to see green tomorrow. The question becomes where? Is it going to be in healthcare? Is it going to be defensives, utilities? That's recessionary. When we talk about NVIDIA, since everybody's excited about NVIDIA, waiting, when it's going to go down, Maverick, when? The answer is when you capitulate and you go long. So why don't you do us a favor already? But anyways, NVIDIA unveiled the new revelations. AI cloud, AI underwear, AI dildos, AI anything. And you know when any company starts to speak in preacher Jim Jones kind of tone, they're probably hiding something here. Take, for example, NVIDIA executives describing the new AI software as the limit of physics being reached. Can you define the limit of physics? A NVIDIA CEO says that AI revenue is expected to grow from tiny to quite large in the next 12 months. You know what's going to grow from tiny to quite large? Is insider sales. Recently, the director of NVIDIA dumped a bunch of shares, and the financial officer also did the same, little by little. Bill Wang himself, Mr. AI, he's going to cash out. And then what? All of this pumping, all of these stock buybacks, so they can cash out and leave you holding the bag. Speaking of holding the bag, how about Mama Cathie Wood? She did you the nasty. She rugged a lot of you guys. In a way, I admire Mama Cathie Wood because she's a vicious killer. She's been pumping Coinbase, AI this, AI that, the future this, the future that. And then today, in the morning, we found out that ARK Invest Mama Cathie Wood dumped her Coinbase shares. Goodbye. And then after the bell, we got the news that the SEC is waking from the coma and hitting Coinbase. And give us a live look of how Coinbase shares are trading right now, and down 20% in a single day. Mama Cathie Wood, I don't know what to say. Is she gonna get away with it? We'll see. But anyhow, moving on to the heat map for the ETFs. Red across the board. Not even chips made it today. Everything is in the red. No exceptions at all. Usually, not always, in the following day we sort through the losses and say, okay, maybe XLU shouldn't go down as much as it did. Maybe XLV shouldn't have gone down as much as it did. Maybe so and so, whatever ticker you want to throw. So it'll be really interesting to watch what they're going to pick up tomorrow. Is it going to be the resumption of the mania? Let's buy the dip in technology and chips again. Despite all of what we gotten today, we'll see. But you got a bull market, folks, and that happens to be in bonds. Look at the TLT, look at the IEF, look at the TIP, look at the SHI, all blasting higher. And the beauty, if you followed what I did and you bought the 1 year a few weeks ago, I bought the 1 year, I bought the 2, I bought the 6 months bill too. The beauty of buying those back then, A, you got an insane yield, 5% plus. But if the value of these bonds continue to appreciate in value quickly, now you got the option to dump them for more than 5% worth of gains. And by the way, bonds are rallying for the wrong reasons. Usually bonds rally along with equities. Not today. What does that say? A recession, baby. Let's do some charts and then wrap it up. When we begin with the SPY, the S&P 500, 30 minutes chart, what do we see here? It looked pretty good in the morning. We're at 400. We're keeping the support of 398. Higher we go. The market maker flushed a bunch of put options holders. They freaked out. Oh, higher we go. The market is irrational, like the pussy bears I've been hearing from all day long. And then they sucked in a bunch of call options holders who've been jerking off to the chart that higher we go to the moon. They flushed them down by the end of the day and took their money too. This is the job of the market maker, folks. Their job is to take both of your money, the bulls and the bears. But now we have what it appears to be a massive reversal candle. We lost support at 398. We lost support at 393.58. We closed the gap and we closed the day below the gap. My expectations are that whatever rebound we get, unless it gets us all the way above 398, we're not out of the woods. Sooner or later, we crack below the trend line and then we go below 390 and then the line in the sand is 385. If that's broken, we're gonna go down and make lower lows. And by the way, a lot of you say, Maverick, you missed the recent rally. Did I? Because I told you it's gonna happen. And I told you it might go all the way to 398, but it's not gonna close above 398. Take a look. Now, what if the chart passes 390? Is that possible? The answer is yes, of course. What about 393.85, Maverick? Maybe, a stretch, but maybe. How about 398? No way, no way. Absent of a bailout or the Fed cutting rates, no way. And then what about the continuous contract for the S&P 500, the daily chart? What do we see here? We have a reversal candle because we have an engulfing candle, meaning it closed below yesterday's lows. It engulfs the body of the previous candle, but it is without confirmation. The confirmation would have been closing below the important support of 3,960. If that is the case, if we do close below 3,960 by the end of the week, then we go down to 3,855. If that's lost, 3,600 for sure in the bag. But the bulls are not dead yet, so long as they close above 3,960 by the end of the week. They're still alive. The RSI is still positive. The MACD indicator is still positive. The positive/bullish momentum did not change, believe it or not, based on today's activities. We need to see more. We look at the SPX, the weekly chart, in my opinion. We got to go down to the 200 weeks moving average. We got to retest it now. What is the point of buying the SPX right now? We got to see how the 200 is going to hold. And that would be a decline of about 4.5% from this point on. And then we got the Qs, 30 minutes chart. What do we see here? The Qs had the audacity to go back and knock at the door at Mrs. 313 without having a piece of evidence, a piece of paper that says that the Qs went to school and now has better behavior and better evidence that it should be grant entry above 313. The Qs showed up without even a dozen roses. Nothing. Just let me in. I'm entitled to be in. We all know, especially the old viewers of this channel, that you don't want to mess with Miss 313. She'll kill you. And today she killed the Qs once again. Massive flush down. We lost 309 as support. We got exactly almost to the gap at 305.91. And then the action stopped. Now, the chart is not oversold by any mean. We can go down further. If we do, we got to go down to 300. That is the battlefield number. When we get there, the bears are going to show up in mass numbers. The bulls will show up to defend 300. So if it is broken, that would be a doubling down signal to short the Qs big time. If it is defended and we see a rebound, then the bulls, so far so good. They remain in charge. Believe it or not, despite the massive drop that we got today, the chart remains bullish. Got damaged severely today, but we need to see more. before we say it's over. Because when we look at the daily chart for the continuous contract, what is the magnitude of the damage today? The answer is one support line. That's it. 12,766 lost the support, and not even by much. The RSI remains positive. The MACD remains positive / bullish, although kind of rolling here. So that could be a warning sign. We're not going to be decisively bearish in the Qs until it loses 12,207 as support. Now, does that mean you wait all the way till that's broken and then you short? If you are a conservative trader, for sure. But if your risk tolerance is a little higher, you can take a swipe at the Qs right now. But understand, if it moves back higher and if it closes on daily basis above 12,766, you gotta abandon the trade because we have a recovery here and the Qs wants to go higher. IWM, an hourly chart. What do we see here? We talked about the bear flag formation. We talked about how weak the IWM is. Even though it found some bottoming in the saucer formation, it popped above 174.22, but it couldn't get any more action. There's not a lot of support to push it higher. Today, it lost the number. It closed below this number. It closed below the gap, and now we have to look down at 168.90. And folks, let's not beat around the bushes here. If we look at a weekly chart instead, we have an important support line, which happens to be a gap fill at 163.62. The chart did retest this support line twice, and it failed to rally. What does that mean? It means it's gonna run another test. But we already got two pieces of evidence that say the IWM doesn't have what it takes to ignite a rally from this support line. Now ask yourself a question. Is the IWM stronger today than it was in the previous two times it did retest 163.62? The answer is it got a lot weaker. So the likelihood is it's going to break through this support line, and this will produce a cascading of selling. When we look at the Dixie, the most important chart, now yours truly was betting that the Dixie will actually pop higher. To my surprise, and by the way, it scares me. It scares even me that we couldn't even catch a rebound in the dollar. And the market said, okay, we've seen enough, back to the recession mode. Dollar goes down along with stocks, and we see bonds and gold moving higher. That's terrifying, folks. Maybe we keep an open mind. Maybe the dollar is going to rebound higher in tomorrow's session. You understand what's going on here right now, folks? We're talking about the dollar rebounding as being bullish for equities. Isn't this a sign and a piece of evidence that we are indeed in a recession theme? And here's the old man, gold. What do we see here? Keeping support at 1928, moving higher. Now it is overbought in the daily. I'll give it a day. I'll give it all the way till the end of the week. If the dollar continues to go down, if oil continues to go down, if bond prices continue to catch a bid, what more evidence do we need to say, okay, this guy, the old man, is going to 2000, and after 2000, it's going to skyrocket. So reserve your seats right now. I'm going to be skeptical for a day or two. If I see more evidence, I'm reserving my seat too. We'll look at UK oil, Brent oil, a daily chart. What do we see here? Caught a bid earlier when the FOMC came out, but then the reaction became peculiar. While we got a reversal in equities and risk assets, indicating a recession is coming, a recession theme, oil did not give up a lot of the gains. It retested 77 as resistance, couldn't make it, and stopped right there. Maybe because the oil session closes a little earlier. We'll see how the commodity is going to react in tomorrow's session. If it reverses and flushes down, we got yet another confirmation that this is a recession theme. Here's the 2-year yield. What do we see here? We'll keep an open mind that we still have a trend line of support. Yeah, we got a down day today, but what if we have a reversal and yields rebound higher tomorrow? Then we see the resumption of the inflation fighting mode, in which it could be positive for equities. But if it goes down again, if it breaks through the support, then we've seen enough. The market, be it the bond, the stock market, the commodities market, they're all screaming that this is a recession. The yield on the 10 daily chart, similar story. Holding on to support, we'll keep an open mind that it might make it above 3.5 tomorrow. But if it doesn't, if it closes the week below 3.5, we got a confirmation that this is a recession theme. Here's the TLT, caught a bit today, closing above the gap. That's positive. Do you chase the TLT right now? How about you wait till 109.5 is broken as resistance and capture the support so you can know for sure the TLT is going higher. But perhaps a better play could be the SHI, for example. Here's a weekly chart for the SHI. We know that in the re-steepening of the yield curve, the shorter end will appreciate more. Not in yields term, but in prices term, which means that the SHI should outperform the TLT if that happens. The VIX 4 hours chart, what do we see here? We got all the way down to the support of 20, and every time the VIX goes down to 20, you want to buy the VIX, you want to short the SPY. And it appears that we have more pain to come in the SPY because the VIX caught a massive rebound. The momentum indicators are improving, indicating we're going to give it another shot at 24.29 and maybe back all the way to 30 by the end of the week. Apple, the big kahuna, 30 minutes chart, an hourly chart. What do we see here? We talked about the rising wedge. It did break today, massive flush down. But do we have any significant damage here that will scare the bulls out of Apple? Absolutely not. We still have plenty of support down there. We're not going to say that the bulls are going to start to scramble or run away and the bears will start attacking until we get closer to 150. Because if 150 is broken, that's it. Apple doesn't have it and the shorts will pile in. But so long as Apple is trading above, let's say 152, Apple bulls can sleep soundly, at least for now. Keep an eye open. We get closer to 152, you got to wake up altogether because it's going to be a battlefield. The bulls lose 150, it's over. Tesla, the souffle, an hourly chart. We talked about all of these hourly charts, way overextended at the risk of pulling back if we have a negative reaction in the aftermath of the FOMC. This is exactly what happened. To begin with, Tesla did not catch a bid earlier on. It got rejected twice from 200 and then it lost 194.55 for support. We have to look down at 187.68 now. The chart did cheat this number by gapping above it. Now it has to go down and say, okay, I'm sorry. Let's do a legitimate retest here and see if it's going to hold or not. If it doesn't, down we go to 180. But the bulls are still alive. So long as the chart is above 180. You lose 180 for the week, it's over. Last but not least, Bitcoin. Bitcoin was negative from the get-go, which was a leading or a telltale that equities will go down to. But Bitcoin did not violate the support of 26,555. For now, it remains positive. The bulls remain in charge. If they lose this support by the end of the week, especially in a flush down, maybe it's going to happen by tomorrow, based on the news of Coinbase, for example, it's going to be a problem for Bitcoin, and we're going to go down to 18,500. But hear me out here. This is a major test, not for just Bitcoin, but cryptos. Was the rally in Bitcoin in the last 2 weeks based on, number one, the weakness of the dollar, banks collapsing, the dollar going down, the Fed will do this and that, you got to dump the fiat and stick with cryptos? If that is the case, then the dollar went down today. Bitcoin should be rallying higher. But if the rally was based on, oh, we see things collapsing and the Fed will have to ease and cut rates, and that will be good for risk assets, then Bitcoin should go down big from this point on. This is a really important test because a lot of the crypto enthusiasts, shall we say, they've been telling us all along that their theory, the mother of all theories of owning Bitcoin and cryptos, is you can't trust the banks. You can't trust the fiat currency. They keep printing more and more and more. Well, if that is the case, the dollar is going down now. Bitcoin should rally higher. If Bitcoin goes down along with the dollar, then we know that the rally was a fugazi. It was just based on, risk-on optimism because the Fed is going to pivot, it's going to pump QE, yada, yada, yada. If that is the case, then what is the difference between risk-on stocks and Bitcoin? If they're all going to rally based on QE liquidity pumping. Lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have initial jobless claims and we have new home sales. And before I log off, an apology to our Top Gun Maverick members. I did a live stream today and I used a new mixer. I did not take the time to set it up properly. I'm going to do that in the weekend. I thought that I was hearing on my headphones is what you guys were hearing. But then I listened to the recording and it was absolutely awful. I sounded like I was drowning. I don't know what the problem is. Maybe some of you audio experts will help me out. But I'll get it done. I'll fix it. And we'll get the live streams properly next time around. With that being said, thank you all for supporting me. Thank you all for listening and watching my program. But this is all I got for you for now. I'll be back tomorrow. In the meantime, take care and good night.
You're not a killer. You have to be a killer.